It's hard to believe that we only have 2 short months before we start another year. And so here are 7 tax tips for you to consider before the end of 2023. I'm Valerie Leonard, CEO and founder of EverThrive Financial Group, and these suggestions may help save you money on your 2023 tax bill. First, review your retirement plan contributions and consider maxing out your employer sponsored retirement plan deferrals. In 2023, the IRS allows you to defer $22,500, or if you're age 50 or older, you can take advantage of a special catch up contribution, which means you can contribute even more, and that's up to $30,000. You heard that correctly. Now, every now and then, your employer's plan may limit you to a lower contribution amount, but for most Americans, you should be able to contribute $22,500 if you're under age 50 or $30,000 if you're age 50 or older to your employer sponsored retirement plan. Second, keep in mind that there are no income limits within an employer sponsored Roth 401k plan. So, this means that if you typically be ineligible to contribute to a Roth IRA because you make too much money, you are likely still eligible to contribute the full $22,500 or $30,000, depending on your age, to your Roth 401k, regardless of how much money you earn in 2023. Now, don't confuse Roth IRAs with Roth 401ks. They're two totally different types of plans with different rules, and there are generally no income limitations on contributing the maximum amount to your employer's Roth 401k. There are, however, income limits when contributing to a Roth IRA. Third, if you plan to make contributions to a traditional IRA or to a Roth IRA, you're going to want to make those contributions by your 2023 income tax filing deadline, which of course is going to be in 2024. But if you make your contributions before year's end, you'll have one less thing to do on your to-do list before tax season. So just be sure to consider your 2023 total income when you factor in whether or not you're going to be eligible for traditional IRA or Roth IRA contributions. In 2023, you can contribute up to $6,500 to a traditional IRA or to a Roth IRA. And if you're age 50 or older, you can contribute up to $7,500 to a traditional IRA or to a Roth IRA, assuming you're not over the income limits. Fourth, you may want to take a look at converting some funds in your traditional IRA to a Roth IRA. So, I want to give you a quick refresher here. When you put money into a traditional IRA, you get a tax deduction today, and then you pay income taxes when you pull the money out in retirement. This allows your traditional IRA to grow tax deferred year after year. Now, for instance, just to kind of give you a simple example, if you make $75,000 and you put $5,000 into a traditional IRA, your taxable income for this year would be $70,000 before you consider any other tax deductions that you get to take. So you're going to save money on taxes today. The amount of income taxes that you'll owe in retirement is going to depend on your tax bracket at that time. And keep in mind that the IRS will also require you to start taking money out of your traditional IRA and pay the taxes on it, regardless of whether or not you need it in retirement. Typically, these required minimum distributions will begin between the ages of 73 and 75, depending on your birth year. When you contribute money to a Roth IRA, however, you don't get a tax deduction today. But there are some benefits to doing so. So, in simple terms, if you make $75,000 this year and you put $5,000 into your Roth IRA, your taxable income will still be $75,000 before you take into account any other deductions that you'll receive. However, when you pull the money out in retirement, you're going to pull the money out income tax free, which means you never, ever, ever, ever end up paying taxes on any investment gains as long as you follow the Roth IRA rules. The younger you are, the higher the probability that the Roth IRA will benefit you most. Plus, under current tax law, the IRS doesn't require you to make required minimum distributions from your Roth IRA account. So this just means that if you don't need the money in retirement, you're not going to be forced to take the money out and pay taxes on it. Additionally, if you believe tax rates are going to be higher in the future than they are today, paying income taxes today may be the way to go. Keep in mind that if you're near retirement age, we need to evaluate your options closely to see whether a traditional IRA versus a Roth IRA would be most appropriate for you. And even if you don't have a lot of time on your side to allow your investments to grow in a Roth IRA, a Roth conversion may still make sense because it could help you avoid or minimize taxes on any required minimum distributions you'd otherwise be forced to take from your traditional IRA. Now, when you convert traditional IRA money to a Roth IRA, this will trigger income taxes today. So, this strategy isn't right for everyone. We can help you determine whether this strategy may be a good fit for you. And often, a Roth conversion strategy is best implemented in a year where your income is lower than normal or implemented over a series of several years. Fifth, take a look at tax loss or capital gain harvesting strategies. Tax loss harvesting simply means selling off stocks or funds that have lost value in order to counterbalance taxes on profits you may have made from the sale of other investments that have gained value. So you may also be able to use realized losses to offset ordinary income. There are some caveats with this strategy, including what we call the wash sale rule, which prevents someone from repurchasing the same or a substantially identical security within 30 days. But it can be an effective approach for overall tax management. Now, capital gains harvesting could also be an option worth considering, especially if you're married filing jointly with 2023 income below $89,250, or if you're single with income below $44,725, because in these cases, you'll pay 0% on capital gains income. This strategy may also be helpful for business owners who expect a net operating loss in 2023 from your pass-through entity, especially if you expect gains in the future. Six, there are multiple charitable gifting strategies to consider before the end of the year. Often making financial gifts to a nonprofit or to your church has the potential to be one of your biggest tax deductions if you itemize on your tax return. And you can give more than just cash. You can also make non-cash donations as well. Contributions may be deductible from a federal taxable income standpoint, but a number of conditions need to be met, such as itemizing your deductions, like I just mentioned. If there are causes that you care about and you want to support them, you're going to want to do this before the end of the calendar year. And some people consider bunching your charitable contributions that you would normally make in 2023, plus those from 2024, into the 2023 calendar year so that you can get a larger deduction this year. You wouldn't get as much of a deduction next year, if any, but you would get a larger deduction this year. And speaking of charitable gifting, if you're subject to taking required minimum distributions from your retirement accounts, you may be able to avoid ordinary federal income taxes on your distributions by making what we call a qualified charitable distribution, or a QCD. So to do this, you can take up to $100,000 of your required minimum distribution and send the money directly to a qualifying nonprofit. In this case, you'll help satisfy all or a portion of your required minimum distribution, and the charity will avoid paying income taxes on the money. In 2023, you also have the option of gifting money up to $17,000 to any one individual without incurring what we call gift taxes. If you're married, you can gift up to $34,000 to one individual. So make sure to pass on any monetary gifts to friends or family before the end of the year. Now, keep in mind, this doesn't earn you an income tax deduction, but it simply allows you to transfer money to another person without having to report it to the IRS on what we call a gift tax return. And the person receiving the gift generally doesn't need to report the gift either. Seventh, there are other strategies that are worth considering from a tax standpoint, like maximizing your health savings account contributions or contributing to a 529 educational plan for your kids or grandkids before the end of the year. If you have the option, you may even want to consider accelerating your future income into 2023 to avoid any potential tax rate increases in 2024. And lastly, by paying attention to your projected tax bracket for this year, that may be able to strategically implement some of these strategies that we talked about and take those tax deductions to avoid a potentially higher tax bracket. Of course, all of these steps are best made with the guidance of a financial professional and or a qualified tax advisor. I hope this video gave you some good food for thought and a framework for managing your year-end finances. Thank you for watching. Click subscribe on EverThrive's YouTube page if you want to be notified of future videos, and I will see you next time.